I'll just start by giving a broad overview of the current global and local macroeconomic situation, little bit about the budget, and of course, then we will share our view on the markets and also run you through our portfolios. So the global economy, as we start 2025, seems to be on a okay footing. Uh, this is not bad news at all. This is good news because we've had now almost 4 years of very good growth post-COVID. The world economy was growing at around 3%. Currently, it looks like we are still on the way to about 2.5% of global growth, which is not a bad outcome after such a nice stint of growth post-COVID. Uh, the US markets were expected to grow at about a little less than before, which is again not too bad for such a large economy at about 2%. Uh, China is expected to grow at around 4.5%. Again, for a large economy, not a bad outcome. And India is expected to grow at about 6.5%. Not bad in the scheme of things. So our status as the fastest growing one of the large economies in the world continues as we speak for 2025 also. The thing that differentiates India versus other markets, especially the developed markets, if you see on the right hand table, is that versus the pre-COVID levels, most of the developed markets are at fairly higher rates of interest compared to 5 years ago, pre-COVID. And that's because of the fact that they've had to stimulate their economies so much, and they did maybe overstimulation of the economy, both monetarily and fiscally, which has led to a inflation problem in a lot of the economies. So that's the reason why they had to hike interest rates. And now on the way down, they are not able to cut at the rate at which they hiked. So as they hiked, because we saw that from 2020 to almost 2022-23, there was a sharp cut in interest rates, which led to growth. A lot of fiscal spending happened, which led to a lot of increase in the debt levels out there. And because of that, from 22 onwards, you have a problem of inflation. And as soon as inflation stuck, from 23 onwards, you've seen that interest rates in the developed markets began to go up. And we are seeing that there is a bit of a slowdown, as you can see on the left. We saw that the US economy grew at almost 3% for 23 and 24, and now it's expected to slow down a little because of higher interest rates. But that's necessary because they have done so much of stimulus. Compared to that, countries like India and China are far better off. Our interest rate levels are not as high as they were pre-COVID, so we are pretty much at normal levels, I would say, and that's because of the reasonably prudent approach that India, China, etc. took in the post-COVID situation. So I think we are, as in terms of debt to GDP, India is the only country in the last 10 years which has actually managed to reduce its debt to GDP even after the COVID stimulus in 10-year time frame. So I think macroeconomically we are in a good spot. Uh, the the main variable which is driving recent volatility and the global markets, especially in the last few months, is basically the Trump trade and the dollar trade. So the President Trump is talking about, a lot of measures like corporate tax cutting, increasing the import duties for goods imported into the US. He's talking about a lot of Make in America by protectionism, etc. So a lot of protectionism is being built into the prices. And the point is that whatever protectionism will do will reduce competition and imports, but it will also drive higher prices. So what's happening is that inflation and inflation expectations in the US are running higher than expected. And that's the reason why you are seeing interest rates out there staying higher. Another reason why you are seeing interest rates stay higher for a long period of time in the US is because, as I mentioned in the previous slide, they have done so much stimulus in the past 5 years that their debt to GDP has already gone up. And if we are talking about tax cuts, etc., it will lead to even higher fiscal deficits and higher debt to GDP. The problem is that a lot of the debt they issued in the last 3-4 years has been in the short term categories, so 2 to 5 years kind of category. And because of that, most of that debt is coming for maturity, and refinancing will be required for that in the next 2 to 4 years. This means that the market is saying that there will be a lot of supply of US bonds in the market in the next few years. So that's the reason why in spite of Federal Reserve starting to cut rates, as you can see in the bottom right chart, the US policy rate has started coming down. But if I go to the other chart, the US policy rates are coming down. But this is the first time in history that the longer bond yields in the US are not responding. And this is exactly because of the problem that I mentioned before, that the market is saying that there will be a lot of supply of paper, and this will be at higher interest rates, which means that in the future, you'll have even bigger debt issuances to refinance because of the higher interest rates. So US is in a situation where they will have to keep on, printing money for a long period of time. And that's the reason you see higher bond yields for the longer end, in spite of interest rates cut at the shorter end. Now, the issue is that because of the higher bond as long bond yields going up, you are seeing the dollar strengthen. So dollar strengthening is something that you can see here. Dollar is almost at all-time highs at 109, 110, and that's the reason why the US dollar is appreciating not only against the rupee but also against most other currencies. So when you are seeing that the Indian rupee is not doing very well against the dollar, we also need to keep into perspective the fact that it is not only the rupee that is a problem, it is most currencies against the US dollars. So that's the reason why we are saying that, while it is not great news that the rupee is depreciating, we don't think it's something to be alarmed about, because this seems to be a global phenomenon. Uh, so you have a situation where you have strong dollar against all the major currencies, but US economy doing well. All other parts of the economy also doing well. And most of the central banks now should be on a gradual easing mode. The thing to watch will be what Mr. Trump does on policy and how the dollar behaves. Our view is that this dollar strengthening has probably run a lot of its course, maybe some more to go. But beyond the point, they will also not be able to sustain, because if the dollar continues to strengthen, then all the gains that they are likely to occur because of higher import duties, etc., will be kind of washed away. In fact, China may be doing a deliberate weakening of the Chinese yuan also from their point of view. Because if the US hikes import duties on China by 10% and the Chinese depreciate their currency by 10%, it becomes neutralized. And if they allow it to, sink before the imposition of further tariffs, that you can't even say that they are a currency manipulator. So I think most of the countries are adopting that approach. Let the currencies weaken against the dollar, so that even if more tariffs come, the currencies will take care of it. So that's the global situation. It is a bit of a fluid situation. That's why you're seeing a lot of volatility in global markets. And of course, because of that, we are seeing volatility in India also. Coming to the domestic economy, we are seeing some recovery. December quarter was a tad weaker, but in the last month or so, we are seeing some, green shoots in terms of better rural demand, etc. So we are saying that 6.5% is the base case that we are going for as far as the GDP growth is concerned, and we don't see any reason to be majorly worried about that number at this point in time. We are expecting headline inflation to come down in the fourth quarter as food prices come down. And 1 year down the line, we are expecting inflation to come to 4%, which is a good outcome for us. The key risk, of course, is that FII outflows do continue. And as I explained, that is partly due to the strong dollar also, and partly due to the fact that the US economy is also doing well. So a lot of money is flowing out from global markets into the US markets. People are also hedging against Trump. This thing, if Trump actually comes up with all these tax cuts, etc., then you can see a upward kicker in the US corporate earnings. So people are moving money towards the US as we speak. Sentiment in India, as far as the consumer is concerned and corporates are concerned, is doing well. As you can see, the orange bar, India is pretty high up there in terms of the consumer sentiment, and even the purchasing managers indices are pretty good for India. So local sentiment is fine compared to most of the other global markets. The other big event was the budget, and it was quite a decent budget, I would say, within the constraint that the finance minister was working with. Fiscal prudence, relief for the middle class taxpayers, consumption boost, continuation of capital expenditure, A lot of PLI outlays for various sectors were increased. MSME and startup support was there. There was a selective import tariff hike in certain items like textiles, solar electronics. Uh, some of the items saw cut to make Mr. Trump happy. For example, motorcycles, etc. We cut import duties because Trump has been always talking about Harley Davidson, etc. The initiatives on the green initiatives and energy renewable energy continue. Good talk about ease of doing business and further improving the regulatory reforms and decent rural and agri support. Special focus on Bihar. Some of the question marks in the budget after the budget is, after all this, will private sector capital investment, further sustain and revive or accelerate, I would say. Uh, this to put things in perspective, for the last 4 or 5 years, the government has been doing a lot of heavy lifting in terms of investments in infrastructure, railway, defense, etc. And the private sector has been picking up, but not to the extent that government was hoping or anticipating. So the PLI schemes, etc., that we talked about, were basically to help private sector investment. Uh, Taxpayers, of course, while there is almost a 1 lakh crore benefit to taxpayers, well, consumption growth actually happen or sustain is something that we need to see, because I think once you get money in your pocket, there are various items that you can spend it on. One is of course you can spend it on consumption, which is buying durables and FMCG. Second is you can save more. Or third is you can actually invest more. Save and invest. And third is basically you can leverage it out to kind of buy something better, so to say. So there are 3 or 4 items that we'll talk about which may be beneficial. In certain sectors in the budget, the capital expenditure was lower than expected. For example, roads and railways. There is not much increment in food, fertilizer, fuel subsidy, basically the rural part. So there's no extra boost, whereas some of the other schemes have seen good increase, like the Gram Awas Yojana, etc. But it's a mixed bag as far as the rural is concerned. The last time there was no big bang reforms in the budget, which is fine. Maybe they can do it after the outside the budget also. Um, Broadly, the finance minister has stuck to the path of fiscal consolidation. The fiscal deficit is targeted to be 4.4 next year, and the path to 3.6% is being shown. We are targeting a debt to GDP ratio of 50%, which is healthy for a country like India. And the thing is that I think the finance minister will continue to be prudent as far as the fiscal is concerned, because we also have been included in the global bond indices, which is a good prestigious, seal for us. And there is a kind of soft or unwritten commitment that we will stay on the path of fiscal consolidation if we are to get, included in the global bond indices, because global bond indices inclusion means that you are going to be prudent in terms of your macroeconomic policies. So that's what we need to continue to show to the global rating agencies. So that's where we are. The budget is quite realistic. Uh, Specific sectors, if I were to talk about, defense has seen about 13% increase in the allocations. Housing and urban affairs, as I said, the Pradhan Mantri the Awas Yojana has seen good. A lot of incentive for states to start investing, and road and railways not that much of this thing. Overall, the government capex expenditure is up by about 10%, which is not a bad outcome. This also needs to be seen in the light of the fact that for 5 years, the government has raised its spending by almost 25 to 30% on a compounded basis every year. So if you see, for many years, our capex to GDP was about 1.5%. We have like almost doubled it to 3.1%, and this is on a higher 1.5% on a GDP, which is almost double that out. So almost 4x kind of capex has been done, has been increased in the past few years. As I said, numbers are mostly believable. They're expecting the overall receipt growth of 11%, which is more or less in line with the nominal GDP growth rate. Revenue growth of about 6.7%. So total expenditure growth of 6.7%, total expenditure growth of 7.4%, resulting in a lower fiscal deficit. So total receipts will grow by 11%, but the total expenditure will grow by 7%. So which is why you are seeing a lower fiscal deficit compared to last year. And we, as I said, we also expect policy rates to start easing. So net, the big number is 6.5% GDP growth rate for FY 26. Inflation by next year should be around 4%, which is a good situation to be in. On the On the fixed income side, as I said, we are expecting the yields to drift lower. You did see after this slide was made, you see a 25 basis points cut in the policy rate. And as you can see, the 10-year bond yield is also creeping down lower. So we expect the 10-year bond yield to stay within a range of about 6.4 to 6.8, probably closer to 6.4 as we go as we drift down the rest of the year. The other good thing is that the RBI has been trying to improve the liquidity situations through OMO operations, FX swaps, and repo operations. So the extreme tight liquidity that we have seen for almost 1.5 years is now definitely easing. One of the reasons so why RBI was keeping it tight was because of the currency, as we discussed. You can't have very loose liquidity when the currency is under pressure. So if the dollar stabilizes and we have a normal situation, then you will see liquidity come back. That should benefit financials like banks and NBFC because that reduces their borrowing costs. So I think, given the fact that banks and NBFCs are a large portion of the indices, it means that you can see a good support to the market because of easy liquidity conditions in the coming year. Uh, So in the equities, a lot of us are focusing on the last 3 months, where India has underperformed a lot compared to a lot of other markets. As you can see on the right hand side, from September to January, India is down almost 13%, which is much more than the other markets. But we also need to keep in light of the fact that for almost 4 years, 21, 22, 23, 24 and a half years, India was the best performing market in the world. So from the COVID lows till September, India was the by far the best performing market in the world, doing even better than US. I think the only market which did better, or only index which did better, was the US technology index, which is the Nasdaq, etc. But we gave returns of almost 31.6% compounded for 4.5 years, which is a massive outperformance compared to everybody else. So I think 12.5% minus after 30% CAGR for 4 years, this 12.5% absolute is actually a just a blip, I would say. I don't think there is anything that we need to worry about as of now. As I said, our status as the fastest growing large economy in the world continues. If I were to look at the EPS growth, and there's been a lot of discussion around large caps, small caps. So I would just, instead of commenting on subjective matters, I would just focus on the numbers. If I look at the large cap, Nifty 100, for example, which is the top 100 stocks, from 2017 and even before that to 2020, we had many years, 5 to 7 years of stagnation, almost just about 5% growth in EPS for the large caps. And similarly for small caps, if you see the bottom. After that, we have seen massive CAGR of almost 20 to 22% in earnings, both for the large cap indices and the small cap indices. And for the next 2 years, by consensus, as per Bloomberg consensus, the large cap index is expected to grow at about 10% or so in terms of EPS growth for CY25, calendar year 25 and calendar year 26, whereas the small caps are expected to grow at about double that level, about 19-20%. So you have the large caps growing at about 9-10%. You have the small caps growing at about 15 to 20, 17 to 20%. So the earnings growth, the growth rate for the small caps is actually far higher, I would say. Uh, then we come to valuations. The valuations of the large cap index, which is the green, is about 20 times on a forward basis, and for the small caps on a forward basis, because we are seeing earnings growth, is trading at around 21 times, which is not a bad outcome. The mid cap index is a bit higher in terms of the in terms of valuations, but let's look at the summary. So you have the large cap index, as I said, growing EPS at about 9% with a PE of about 18, 19%. So if you look at the PEG ratio, it's about 18 by 9, which is about 2.0. If you look at the mid cap index, P is about 23 as we saw. The EPS growth is about 12%. So peg of again 2. For the small cap index, the P going forward is about 18. EPS growth is about 19. So peg of about 1, so to say. So adjusted for growth, small caps don't look too bad. And to put things in perspective, there are 100 large caps, 150 small caps. But if you look at 2000 crores as a market cutoff, there are another almost 800 stocks to choose from. So there are stocks which are still available if you do the right picking and choosing, which can give you a decent combination of growth versus valuation. So I don't think the opportunities in small caps or mid caps are completely vanished if we do the right things. Uh, from the equity markets point of view, one of the big pressures on the market has been the FIIs selling, as you can see on the left-hand chart. FIIs have been selling a lot, $10 billion in October, $3 billion in November, $8 billion almost in January. So large amount of selling has happened. But the good thing is that it has been more than matched by the domestic net buying, DII, mutual funds plus insurance. Of course, bulk is mutual funds. So against $10 billion of selling in October, you saw $13 billion of buying in by the DIIs. Against $3 billion of selling in November, you saw $5 billion of buying by DIIs. Against $8 billion of selling in January, we saw almost $10 billion of purchase by the DIIs. So, it's been the selling by FIIs has been more than met up in the cash markets, at least by the DII purchases. Of course, part of it has been due to a cyclical slowdown in earnings. As you can see that from a profit growth of about 27% in FY24 quarter two, which is September 23 quarter, by September 25, by September 24, the earnings growth for the broader indices came down to 8. But we do believe, as you can see from the consensus, that this is likely to be higher going forward. The reason why you saw a huge amount of uptick in the September 23 quarter was because of a base effect. If you remember, in 2022, because of the Ukraine war, commodity prices went up and margins actually went down for a lot of companies in the 2022 year. And because of that margin low base, when commodity prices corrected in 23, you saw the benefit of margin improvement in the company. So you saw a huge, on a lower base, you saw a huge increase in profits. Though because of commodity prices not going up, top line did not grow. It was only 8%, but margin improvement led to a 27% improvement in the PAT growth. Now all that is normalizing, and margin improvement is normalized, or margins are normal, and now we're back to a cyclical growth. And as you see, if India is to grow at about 6.5%, the nominal GDP should grow at about 10-11%. So corporate profits should grow at around, as you saw, about 10 to 12% for the large caps, and at higher levels as we saw for the mid and small caps. So I think we are back to normal cyclical upturn as we speak. So far, if you can see, the broader market is doing better. So this is a little bit of update on the on the earnings season. So if you see for the top 50 companies, the top line growth is about 5% for the results declared so far. And the top line growth is about 6%, a little more ex oil PSUs is a bit higher. So 5% for the Nifty 50 companies. If you remove the oil PSUs, because there the price are controlled and all that, a little better in terms of the broader market. If you look at the earnings growth, again for the Nifty 50, so far it's about 3%, but for the broader market is 12%. So you can see that, broader market, which includes small cap and mid cap, is actually doing better than the large cap indices. So when we compare large cap indices PE to small cap index PE, we also need to keep in mind that earnings growth is also what matters. And so far, it looks like the earnings growth for the smaller companies are coming out better. One more point on the outflows by FIIs. I did touch upon it, but to re-emphasize the same point. Last year saw outflows from India, as you can see. Significant outflows of not significant, because first half we saw plus and then we saw minus, but some outflows from India. And of course, in January also we saw outflows. But India was not alone. You saw outflows in most countries. Brazil, Malaysia, Philippines, Korea, Taiwan, Thailand, Vietnam, all mostly emerging markets saw outflows in 2024. And same trend in January 2025. So India is not alone. That's something that we need to keep in mind as far as FII flows is concerned. The other things that FIs have been doing is they've been shorting on the futures market. As we speak, their short positions in the indices are at record highs. So apart from the selling that they've been doing in the cash markets, which we saw, they've also been shorting the futures. Now, it's a glass empty or glass half full situation. So if they come to cover these positions, then you can see a lot of partly a rally because of short covering also. Otherwise, corporate sector is very healthy. Corporate debt to GDP is at near lows. If you look at the situation in 2012 versus now, it's far different. So most of the corporates are very well unleveraged, no debt, etc. And banks are also very healthy. If you see the NPA, the only trigger that the banks need now is credit growth. NPAs are fine, balance sheet strength is fine, very clean. So once we get credit growth, I think banks and NBFCs should start doing very well after 2 years of underperformance. And as I said, because of rate cuts and because of liquidity improving, you should see financials begin to outperform, especially the lenders. So we already spoke about this. Generally, our sector views are as follows. We are bullish on broadly the consumption theme, especially the premium consumption items like automobiles, high-end automobiles, real estate, other discretionary like durables, consumer durables. We are talking about, for example, high-end other items like liquor, real estate. Then we also talk about say travel and tourism, aviation, hotels, all those discretionary spends, I think will do well. The benefit of the budget tax cuts, I don't think will flow that much to FMCG. We are not that positive on FMCG because FMCG is already a very well penetrated category. So we don't see too much incremental benefit there. That should benefit from a normal rural uptick, which is what we are booking on, but not because of the budget. Financials, we talked about how the liquidity will benefit. We continue to be bullish on capex, infra, manufacturing, rail, etc. Healthcare. We are bullish on most segments, specialty chemicals and new age companies. And we are in general negative on the commodities, global commodities, metals, cement, utilities, and large cap IT, neutral to negative. So that's where we are. So the potential triggers for the market, I would say, are going to be rate cuts. We are expecting further 25 bips probably next quarter. The dollar is something that we need to keep tracking, and because of dollar, Japanese yen is also a funding currency. So we did talk about it a few quarters ago that if the Japanese yen depreciates beyond the point, then you can see some volatility further in the market. As of now, it seems to be under control. We talked about FII flows. We talked about consumption data, which we need to monitor, and any government push in the second half may change the sentiment for the positive. And the icing on the cake is if Mr. Modi, in his third term, decides to go bold and really go for strong structural reforms, then that can add to the positive sentiment on the corporate sector, the animal spirits, as we call. So with that, I think the market view broadly I've covered, equities and fixed income and the macro part. I'll now request Akash to run us through our funds positioning and what we are doing in the funds.
Yeah.
Akash.
Thank you, Mihir. I hope I'm audible.
Yes.
Okay, just give me 1 second. Okay, my screen is visible?
Yes, sir.
Okay, good evening to everyone. I'll just quickly run you through the Trust Mutual Fund, Flexi Cap and Small Cap positioning. So let me just dive into the Flexi Cap. So this is the way the Flexi Cap fund looks like as of now, well diversified. This is the way the top 20 holdings are looking like. The top 20 stocks are about 54% in weight. And we've given you the top 20 holdings by allocation in the fund. Top 10 is about close to 36-37%. If you look at the next slide, this is the holdings across the top 10 large caps, followed by mid caps and small caps. So if you notice on the right of your screen, you'll get to see a lot of mid and small caps where I think the longevity of earnings growth will be fairly strong over the next 3 to 5 years. And some of these names would feature in part of our emerging, small to big gorilla candidates. Coming to how the fund is allocated across different sectors and market caps. So to the left of your screen, if you see, as of now, 52% of the FlexiCap fund is allocated towards large caps, about 21% in mid caps, and about 19% in small cap. The same for the benchmark is shown in blue. Benchmark is about 71% in large caps, and at the extreme end, 10% in small caps. So we have taken significant outlier bets in small caps and mid caps, both vis-a-vis the benchmark as well as many of your peers in the flexi cap category. As of today, the fund is invested in about 56 stocks. If you see the table on the left corner, you will get to see the number of stocks across different categories, large, mid, and small. Close to 17 stocks in small, 18 in mid cap, and about 20 odd in large cap category. To the right of your screen, you'll get to see the sectors that Trust FlexiCap Fund is allocated in, and vis-a-vis the benchmark, what is the overweight or underweight. So I would like to highlight a couple of sectors. So primarily healthcare, if you see the middle of the table, close to 12% allocation in healthcare, vis-a-vis the benchmark, which is at 6%. So a significant overweight to healthcare of about 6%. And we've been overweight healthcare for the last couple of months. It's not only this month. In both our funds, in fact. The second big overweight position is towards industrials. Again, 12% odd vis-a-vis 8.5%. So 4% overweight. Industrials actually covers a wide gamut of companies across defense, across contract manufacturing, across the capex theme in our country, EPC companies. So wide array of companies in industrials actually. The third big overweight is IT. Within that, we are more overweight towards the mid-cap IT companies. So close to 13% weight in IT versus 10.5% in the benchmark. So that's a big overweight. How is this overweight funded by? It's funded by an underweight in commodities and energy primarily. So if you see about 5.5% underweight in commodities, close to a 4% underweight in energy. With regards to financials, we are more or less in line with the benchmark, about a 1% underweight, not a big underweight. So those are the key sectors in which the fund is allocated towards. Moving on quickly to the small cap fund. So we finished about 3 months as we speak in the small cap fund. As of 4th or 5th of Feb, we finished close to 3 months. So we've had a decent start, I would say. This is the way the top 20 holdings are looking like. So again, a fairly well-diversified fund. We maintain that we'll be keeping in the vicinity of 50 to 60 stocks in both the funds. So close to 60 stocks are present in the small cap fund. The top 20 weights are nearing 40%. The highest being around 2.5%. So yeah, very well diversified again at the top, not very top heavy. Here we are showing you the top 10 mid caps on the left and the top 10 small caps by allocation on the right. So I'll let you glance through it for a couple of seconds. Coming to the sectors and how the market cap split of the fund looks like. So as of today, close to 75% of the fund is allocated in small caps. AMFI requires us to maintain minimum 65% and the balance 35% can be across any category. So we put 75% in small caps. About 17% is towards mid caps. And we don't have a single large cap allocation as of now. As you can see on the table on your left corner, about 50 odd stocks in small cap, 11 stocks in mid cap. So cumulatively, the portfolio has 62 stocks that we've invested in. To the right, you'll get to see the sectors across which we've allocated. The benchmark is small cap 250 index. So a couple of commonalities between the flexi cap and the small cap. Healthcare, for example, is a significant overweight in both the funds. So again, a 6% overweight in the small cap. Industrials again is an overweight here, close to 4% overweight within industrials. And IT being the third large sector, which is again an overweight, 2% overweight. Again, the overweights are funded by low exposure to commodities, 5% underweight in commodities, and energy, a 2% underweight vis-a-vis the benchmark. Financial services over here shows up as almost a 10% underweight vis-a-vis the benchmark. We have tactically taken some bets, booked some profits in financial services, specifically some stocks related to NBFCs and a few high beta stocks linked to the capital market ecosystem where we have booked some profits, and we may choose to get back in at a later date. But as of now, we've taken some money off the table in financials and increased bets across the key overweights, as you can see. So that's it from my side. Just before I conclude, let me just show you how the returns stack up. This is since inception, annualized performance. So Trust Flexi Cap Fund is showing about 13.4% annualized return versus the benchmark at about 5.7. So decent amount of alpha generation since inception. And for small cap, since we've not completed 6 months, we are not reporting the returns here, but obviously you can see it on most websites. So I think I'll conclude there. We can take Q&A as of now.
Thank you.
I'm going to stop sharing.
Thank you, Aakash. We have already a couple of questions lined up on the Q&A session, so maybe I'll read them out. You or Mihir sir can take it up. There's a first question. There's a general view from many fund houses to stop SIP and lump sum investments in small cap and mid cap funds. Your take, sir.
I think
we knew that was coming.
I think there are 3 or 4 questions along the same line.
Yeah.
Then there is a talk about the article by one of the CIOs, and there's one question by Sandeep on the sell-off in small and mid caps and SIPs, etc. Then Manoj Jain has asked a question, and yeah, so I think there are 3 questions along the same line. I think Sanjay Mehta is also talking about staying out of small caps. Some of the market participants have said that. So let me answer that. I think first, as I said, I would stick to the data instead of making subjective comments. Let's look at the dispassionate data. The first data I shared with you was on valuations. As you could see, if you look at the earnings and valuations equations, earnings for the small cap index is expected to grow at almost 17 to 20% for the next couple of years. For the large cap index is close to 10%. 10% is not bad, but 17, 18, 20 is definitely better. Then we talked about, so that's the earnings growth part for the next couple of years. Now juxtapose that with the valuations, which is a PE ratio. And as you saw, 21, 22 for the 18, 19 for the large cap index and 21, 22 for the small cap index. So if you see the large cap, it's lower growth, a little lower valuation. The small cap index, higher growth, a little higher valuation. But if you take the ratio of growth versus valuation, then the small cap index actually is not bad at all. So I think I'm not too worried about the valuations if you adjust for growth. And if we have a view that India is likely to grow at 6 to 7%, then I think all the earnings expectations are valid, I would say. So that's one thing on the valuations versus growth part. So that's one part of the argument. Second is, I don't know why we are panicking so much, frankly. From the 52-week high, let's put things in perspective. The Nifty 50 is down about 11%. The mid cap index is down about 13%, and the small cap index is down about 16%. Right? So it's down, but also look at the fact that for 1 year, even now, the Nifty has given you 9%, the mid cap index has given you 8%, small cap index is still positive at 4% on a 1 year rolling basis. Of course, if you look at 1.5 years, it's even better because the small cap index has started to pick up from that. So 1 year returns are still decently positive for Nifty and mid cap. The drawdown is more or less plus or minus similar for large, mid and small, 11% on one side, 16% on one side. So, I mean, there's not a vast difference. But look at the 3 year performance. And if you look at the 3 year performance, the mid cap and small cap indices have given far better returns. So if you adjust for volatility and longer term returns, I don't think we are in a situation where we can panic about the various asset classes. So I think everybody has their view. Everybody entitled to their view, but we are sticking to the same stance that we projected when we launched the small cap fund. Exactly same questions we were getting. And for those of you who have not been able to go through our small cap deck presentation, I would urge you to go through it and ask my salespeople to share the small cap NFO deck with you. It's got immense amount of rich data on why small caps make sense in the current situation. The broad arguments being that India as a market is diversified now. As I said, the large cap index, especially the Nifty 50, is now composed of financials at 35%, IT at about 15-17%, and this is also large cap IT, where the growth rate is only about single digits. Financials are GDP plus, so we are bullish on financials from the valuation point of view, but they are not going to be your 25% compounders. Because most of the financials in the Nifty are also large caps. So they'll grow at 14-15%, good growth, but they're not going to be 25-30% compounders. IT large cap, 17% of the benchmark, will grow at 7-8-10%. Then another 10-20% will be in stocks like oil marketing companies, the large petrochem company, the large refining company, which will again be very cyclical and low PE. So the composition of the top 50 Nifty is actually quite global in nature and financials, which are not high growth in nature. So if you believe that 6-7%, 8% GDP growth for India is going to happen, there will be hundreds of stocks in the small cap segment to choose from. As I said, there are top 100 large caps, next 150 mid caps. So even if you remove top 250, there are another 800 odd stocks, 850 odd stocks probably, with a market cap of more than 2000 crores, which is our universe. Now, if I say that I can't choose 50 stocks out of those 850 stocks, then it's really a bit of a stretch. I don't think we are doing our job well. So I think there's enough scope for stock picking in the space, and that's what I would like to, rest my argument upon.
Thank you, sir. So there is a question, there are a couple of questions on FIS selling. So if you want to address that, they want to know the view on FIS selling last. How long is it
Yes.
going to last?
So I think I partly touched upon it. So I refreshed that part, which I talked about the dollar. So the FII selling is a function of dollar strength, and the dollar strength is also because of the bond yields in the US going high, and the bond yields in the US are going up are because of the huge fiscal deficit and the refinancing of bonds which are going to happen in the US. So I think the high interest rates in the US are making it attractive for money to go to the US, and that's why you are seeing a stronger dollar. And because of stronger dollar, you are seeing outflows not only from India, but also from a lot of most other countries actually. And of course, Trump is talking about making America great again. So thoda इसमें भी story अच्छा बन रहा है. I think with in the next few weeks, this Trump hype will become a little more clear and equations will settle down. And then we should, I think, see the stability. In fact, over the last 1 week or so, if you notice, the FI numbers have already started tapering off. So they used to sell 3, 4, 5,000 crores a day. Now it's come down to maybe 500 crores or 1,000 crores a day. So that is already kind of slowing down. Fingers crossed.
Thank you, sir. There's a question, is the market bottomed out?
Is the market bottomed out? Difficult call. But as I said, as far as our approach is concerned, we are going stock by stock by stock by stock, really going down to each and every stock, taking corrective actions wherever required, putting stop losses wherever required, and being really on top of the wall. And from our point of view, as you can see, we are not a very large fund house, so we have the luxury of being agile. And if there are mistakes, we are able to correct them also in due course. So I think, as far as the situation is concerned, we are not too worried. As I said, valuations, so definitely we are not worried if growth comes true. So if everything goes as per current analyst projections for the broader indices, I am not too worried about valuations, frankly.
Thank you, sir. There's a question, one rate cut already came in. When are you expecting another, and why underweight on financial sectors?
Good question. So Akash, maybe you can dwell upon the lenders versus non-lenders, and why we are now getting incrementally more bullish on the lenders also compared to before.
Yeah, hi. So thanks for the question. So the underweight on financial sector is primarily more so in the small cap fund, as I shared, about 9 to 10% underweight. In the flexi cap fund, we are almost neutral. We have close to 1% underweight. So what has happened is that ever since we started both the funds, we were significantly overweight the capital market theme. be it exchanges, brokers, AMCs, the intermediaries across, things like RTAs, so on and so forth, mutual fund distributors. So at the peak, we had close to 9 to 10% allocation towards capital market stocks. Now, what we've done is that we realized that the growth outlook is improving in other sectors. So primarily NBF, some of the leading NBFCs in our country, some of the large NBFCs are doing fairly well. The asset quality issues are not as much of a concern in some of these companies. Also, with the RBI now taking a stance on liquidity easing measures, as well as the rate reduction cycle that is upon us, I think some of these NBFCs and the banks also, which had liquidity constraints and were not able to sort of grow because of LCR norms, would start to do incrementally better in this calendar year vis-a-vis last calendar year. So there is value emerging in those sectors. Actually, there was value always there. For the last 3 years, we've not seen stocks doing well in those two sectors. But now I think that as we move into 2015 and 2025 and 2026, the triggers are also coming along. So maybe the value could come through and the stocks may end up doing well. So to fund this allocation towards banks and NBFCs, we've taken some money off the table in the capital market linked stocks where we thought there could be a bit of a volatile patch in Q3 and Q4 specifically, because a lot of their earnings are linked to how the equity market does. So that's what we've done in these two sectors.
Thank you, Akash. So there's a distributor who has asked 5 questions together. So do you want me to read it out, or we'll go one by one?
How many stocks are tracked? That one?
Yes, yeah, the same one.
Okay, so we have 5 analysts in the team. 4 actually. Fifth is in the process of being hired, and total will be 6. We had planned to hire one more, so it's as of now myself, Akash, and 4 analysts plus 2 more which are in the pipeline. On an average, we track about very actively track about 220 stocks as of now, which we will keep on expanding as we expand the team. Do you have any market cap filter criteria? Typically, we are looking at 5 to 10,000 crores minimum market size. But if you see our portfolio, there are certain stocks which are lower in terms of market cap also, where we found that the valuations were just too cheap and the growth was very attractive. So while we try to stick to at least 10,000 crores market cap, we can go down because, as I said, we are a small fund. We have the luxury of being able to get in and get out if required. So that's how we are a little more flexible. How do we seek to differentiate from other fund houses, focusing on the growth style of investing? Uh, for those of you who have not, for those of you who have attended some of our roadshows for Flexi Cap Fund and Small Cap Fund, uh, and if you have not, I would again urge you to look at those presentation decks, very rich in information, very good examples, especially in the FlexiCap deck. We have given as to what we mean by our style of growth investing. But we follow what we call terminal value investing. And the core of the philosophy is that for high growth stocks and sectors, it's not the next few years of growth that matter in terms of valuing the stock, but it's the longevity of the growth runway, or the length of the growth runway, longevity of the growth, path is what matters. So typically, when we are buying a stock, we are not only looking at next 1 to 2 years, but we are trying to take a call on how long the growth phase will last for that fund, because ultimately 70-80% of the valuation of the company actually comes from the terminal value, which is the value of profits beyond the next 2, 3, 4, 5 years. So that's what differentiates us in our style of growth investing. Someone with 50-year plus horizon, should we stick to small cap only? Definitely, small cap makes more sense over the long period of time because as again, we've mentioned so many times with good examples in the small cap NFO deck. Essentially, India is a growth market, and in a growth market, there are always new sectors, subsectors, or stocks or business models being created. And when such sectors or subsectors or stocks are being created, they invariably start small. right? So if you want to really capture the full development or growth of that segment for 5, 10, 15, 20 years, and this exactly fits in with our style of terminal value investing, where we are trying to see whether the growth will last for 1 to 3 years. So whether it's cyclical or it's actually a 10, 15-year-old long story. If you think it's a 10, 15, 20-year story, then it makes sense to pick stocks when they are small and ride the entire wave.
Thank you, sir. In fact, he has another question on your take on factor investing funds.
Akash, you want to take that?
Yeah, what is our take on factor investing? I think some of these smart beta funds have become fairly popular. I think in the last 2, 3 years, a lot of NFOs have come about, momentum this, momentum that, value this, value that. Actually, all the back tested data looks good, but I mean, look at what's happening currently, right? I mean, nothing works. So, I mean, it's for those guys who want to be taking part in the passivization of asset class. I think there's enough and more alpha to be created by active fund managers. I mean, one can have an approach of satellite funds and core funds like I've always said. So let the core be some of the active funds, be it a flexi fund, be it a mid cap or a small cap. And if you want to take exposure to passive funds, then let that be part of your satellite portfolio. So they do well in back tested data. Now time will tell how they do, in times to come. So I don't have.
And on a lighter note, if an active fund doesn't do well, you have a face to blame. But in a quant or a model-based investing, who do you blame? You can't blame the model.
Yeah, see, all of this, passive funds, the debate between passive and active keeps happening. But the thing is that, look, you need an active fund manager to actually discover the value of a stock, right? Whether the stock should go up 5x, 10x, and then eventually become a momentum stock or a deep value stock, or come in the index, or be part of the next 50 or not. I mean, it's the active guys who determine that, right? I mean, so we are doing the valuation analysis, we are figuring out, growth prospects, meeting managements. And the passive guys are piggybacking on the hard work that we do as active fund managers. So I think active fund managers are doing fairly well in India. This is a debate which keeps getting borrowed from the US. In the US, with their size of the economy, it's a fairly developed market. But look at what happened in the US in the 1980s and 1990s. Active fund managers and active AUM grew at 25% CAGR for almost 1.5 to 2 decades, not just 1 to 2 years. So India is in that phase, but if you still like to be part of passive brigade, then, I mean, there's nothing wrong with it.
Thank you, Akash. There's another question in comparison to the cash position with other fund houses. Request your view on managing cash in the portfolio to enhance the performance.
So again, in our NFOs, we had mentioned our style and the approach of asset allocation. We are not going to take big cash calls to generate alpha. We will continue to do stock and sector selection to generate alpha. So don't expect us to be 20% in cash or anything like that.
Can I know more on Mihir's active role in fund management?
We are as active as can be. Akash and I both are named fund managers, and we absolutely work 100% together with full understanding.
So there's a question, what portfolio churn are we looking at?
We're not really targeting any portfolio churn, but all I can say, and what again we keep saying in our roadshows, is that we will be active managers of the portfolio. And by active, we are active in monitoring the portfolio, active in monitoring the developments, active in analyzing those developments and news flows, and active in acting on those news flows and developments. So that's one. And the second part of being active is taking active bets against the benchmark, which Akash showed you in the portfolio. We are taking big overweights and underweight calls on stocks as well as sectors. So by sometimes you can choose to be actively inactive because nothing is happening, so you stick to your holding. And sometimes you can choose to be actively active, which means that something has happened and you act upon it. And to repeat, the advantage that we have is that we have a small size as of now. And if something goes wrong and we need to reverse our call, we're able to do it quick enough without too much of impact cost.
So there are just we'll take a couple of more questions, maybe two more. There's one on liquidity of small cap stocks. If you get complete redemption, in how many days can you sell the whole portfolio? Considering the fact about the negative mindset in the market.
Whole portfolio, I don't think everybody's going to ask for their, for their money back. But as I said, we are too small in the scheme of things as of now. But just to, again, put things in perspective, the small cap market cap itself is, I think, close to 90 lakh crores, 100 lakh crores or thereabouts, right? So even if you put all the small cap funds together, it's still a small portion of the overall small cap market cap, I would say. So industry wide also, I don't think we need to worry. And for us, we are like 500 crores in size, not even a drop in the ocean, no problems.
When you start to get such questions, then you know that the market bottom is coming probably.
Are you planning with hybrid funds since it's a low risk strategy?
Yeah, I mean, hybrid funds, we'd rather do the balanced advantage fund because then you can get both set of investors who want some safety in fixed income and the benefits of tax for the equity portion. That makes sense, but I would say that ultimately the alpha has to come from stock picking only. Balance, it's a good way of packaging, but the core, of course, will remain our equity funds.
So there's a distributor's requested to allow him to talk because his question is little longish. So I'll just see if we can allow him to talk. Maybe oppose that we can end the call. That is the last question we can take. Just let me check.
Sure.
Mr. Josefa, I
Yeah,
have.
thank you for the opportunity. There are two queries I have. One is the top line growth which you showed was around 6-7%, 1870 companies. The agriculture is growing around 6-7%. Then how is the nominal GDP growing at 12%? For nominal GDP to grow at 12%, the SME sector should grow at 15-18%.
So the GDP is expected to grow at about 6.5%. And if you add about inflation of 4 to 5%, that makes it about 10.5 to 11.5% nominal GDP growth rate. And corporate
Yeah,
sector typically grows a bit faster than that.
but the top line is growing at 7%. That's what your slide showed.
Yeah, that's because of the commodity prices having moderated, I would say.
So
And this also includes a lot of oil companies also,
So the
No,
other thing,
even if you remove the oil company, it was 7%.
Yeah, that's
sorry, Josefa, the other
Okay,
thing one
secondly,
needs to keep in mind is that the GDP of the country and the profit growth or the top line growth of corporate India is not always correlated in a very short term basis. Over the long term, this correlation works out. But on a quarter to quarter basis, I would urge you not to sort of look at this correlation.
okay, second thing is the recent recently last 4 years there's been a margin expansion, and there has to be a mean reversion in margins, which is starting. How long this mean reversion will last?
Mean reversion will happen. So you had extraordinary margins in September 23, and then you saw the margins normalized.
No, I'm talking about the last 4 years averaging.
Yeah. So I'm saying 22 margins got compressed. 23 margins were very high because commodity prices corrected a lot. Now we are back to normalized margins.
So are we in a normal margin state now as an economy?
Oh, yes. And if the GDP grows faster, then probably some pricing power may come back and you might see some improvement, but not dramatic improvement in margins.
So what will be the next trigger now?
In what?
As an economy and then impacting the stock market. So what is the next? It's like we are in a state of almost.
So we are not saying that we are going to make 20% CAGR in the equities in the next 3 years. We're not saying that, right? So
Yeah,
we'll be back to normalized returns. Long term, Nifty has given you 11-12%, the top 50 stocks. Hopefully, mid caps and small caps should do a little better than that because of the earnings growth that we talked about. So that itself should be a good trigger, considering that you're not making anything more than 7-8% in bonds in any case, right?
Okay. So one last query. In the recent times, the retail investor is a large play in the stock market, and retail investor is usually considered a weak hand. So does that worry you?
I think that water has flowed under the bridge. That ship has sailed. I think the way retail sentiment and flows have held up in spite of such massive FII selling and absorbing the volatility of FIIs does mean that there's a whole new set of investors coming in. And I think the difference this time around in the last 5 years, what has happened is a lot of the money is very granular in nature. It's a lot of small ticket. You got a million demat accounts being opened every month. You got, so many folios getting created every month in mutual funds. And these are very small ticket items, which are more or less systematic flows. So this habit of systematic investing, whether it's through insurance or through NPS or through EPF or through mutual funds, of course, is kind of getting more ingrained. That's one. Second is also the fact that people are also looking at alternate options to gold and real estate on a more serious way. So this whole theme which we are saying, financialization of savings is what it is. As savings go up, as income levels go up, as demographics change, you will see a lot more flows to equities and financial assets.
Thank you, sir.
Thank you, Mr. Josefa. I would like to thank everyone on behalf of Trust Mutual Fund for joining us today on this session. Thank you, Mihir sir. Thank you, Akash, for your wonderful insights on the markets post budget. Thank you. Thank you, everyone.
Thank you.
Okay, thank you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.